Well, hey there, everyone. Happy Wednesday, July 8th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a gorgeous day here in Redmond, Washington. We're back to kind of the sweet summer weather. It's currently currently is 69 degrees. We got a high of 72 here in Redmond. It's pretty killer. Hope you guys are all staying cool and doing well wherever you are at. And welcome to the show. Those of you tuning in live, and I see a lot of friendly names and faces in the chat so far. Welcome. Great to have you guys as always. Please take advantage of the chat to drop questions as we go. If you're watching the show later on our YouTube channel, hey, you're part of this too. All right. We're all part of the Keller Nation, Keller family, whatever we want, the Kellerites, I think it was called recently on IBD Live. You are welcome to ask questions in the comment section of our YouTube channel. And thanks so much, as always, for checking out the show and supporting me in my work. I appreciate it. As we talk about the markets today, I mean, a painful open. Obviously, the market's continuing to go risk off as headlines out of the Middle East, out of Europe, seem less and less peace-oriented and more conflicty. And as a result, you're seeing crude oil prices pop higher. We're seeing rates pop higher. We're seeing risk assets generally go lower. Now, it was pretty rough around lunchtime, but it was sort of like we all had a nice lunch break and started to get a little more optimistic. So by the end of the day, the S&P only losing about a quarter of its value. The Nasdaq composite, the Nasdaq 100, actually ended up in the green. That's how good of a recovery it was in that sort of early afternoon time. Technology and the strength in tech really saved the day here today. Energy was the number two sector technology was the number two sector after energy, which was the best performer. But that renewed strength in tech really allowed things to hold up, including semiconductors, a group we've been talking about quite a lot recently. All right, let me share some charts with you. We will talk about the market recap, talk about the major averages here on the stock charts platform. We will go to the heat map and focus on some sector and group themes today. And then we'll finish off with a bunch of stocks and individual charts that I've hand selected to review with all of you. As always, the goal with this review is to keep you informed, keep you entertained, hopefully, but also help you understand how we can apply technical analysis tools to better quantify investor sentiment, to better identify swings in momentum, and to respect the trend. And that is going to be a key theme we review, I think, today and all days on the show. Here's what happened with the major averages. The S&P down 0.3%. That's a close just below 74.83. The Nasdaq composite, as I mentioned, with that kind of afternoon rally, was able to regain the zero line. And by midday, I mean, this looked like it was going to be a really risk-off kind of day. Nice recovery into the close. And again, the strength in tech really helped change the complexion of this day through the course of the session. Another way to just recognize what happened today, the S&P 100 mega cap index down 0.2%. The mid cap and small cap indexes down 1% and 1.2% respectively. So it was the mega cap growth that really kind of helped a bit of a recovery here more than anything. The VIX was up to the mid 18 level by lunchtime Eastern. By the end of the day, back below 17. And so, again, what looked early on like a pretty risk-off kind of day really improved in the afternoon. And this is one of my mentors, Jeff Weiss, would always tell me, wait for the close. And I would come in around like 11:45 a.m. Eastern. I'd, burst into his office and, we'd talk about something and he'd be like, David, just wait for the close. Until the close, nothing's happening. It's all noise. And I couldn't believe how much he wasn't reacting, in my opinion, enough to what was happening during the trading day. But days like this remind me, Jeff was just so good about being patient and just thinking about, look, until something happens on a closing basis, it didn't happen. That's why we wait for that validation of the entire trading session. And I think what he realized, which many of us have, is that last hour of trading, that last 30 minutes of trading, a lot of times means quite a bit. And recognizing the importance of waiting for that is pretty valuable. So volatility, which looked like it was headed toward 20 as the hours progressed, things got a little bit better. So it sort of snatched a victory from the jaws of defeat today, which is pretty good to see. Rates generally moving higher. That's been a trend we've been observing here. The 10-year yield is certainly starting to rotate higher this week. It did come off a bit as bonds rallied in the afternoon along with stocks, but the damage had been done. The 10-year yield is pushing 4.6%. The long bond yield getting up toward 5.1%, which is a level it hasn't seen in a little while. The dollar index came down a bit. It actually was pretty strong out of the open. So out of the open, it was very much risk off, strong dollar, higher rates, weaker equities, weaker crypto, and then all of those trends kind of shifted in the afternoon. It was sort of two different sessions today. In the afternoon, dollar coming off ended up being negative for the day. The commodity space ended up being pretty mixed. Obviously, the big moves in the energy space, crude oil prices, the Brent crude benchmark, both spiking pretty good. This is as headlines out of the Middle East have sort of implied that whole peace deal thing, the memorandum of understanding that's out. We're now, back to bombing. And as a result, what's happening is energy prices are going right back up. It's enough to push crude oil back above its 200-day moving average. And that breakdown of the 200-day, I think that was in June, seemed pretty meaningful, certainly. And we're getting very close to that $80 level on Brent crude for WTI crude, which is the U.S. benchmark. We're at $75 a barrel, and anything over 80, I think seems, that's one of those where you can kind of ignore it until you can't. And I feel like crude oil above 80, that's where you'll start to hear people, thinking about the potential ripple effects of those higher crude oil prices. Soft commodities down, precious metals down, gold and silver, and silver especially down 2.8%, ended up being one of the worst performers there on that page. All the cryptocurrencies generally lower today. Bitcoin down about 2%, currently just above 62,000. Ether prices around 1735. And again, all of the top 10 coins in the red today. Looking at the 11 S&P sectors, some of these really improved going into the close, and that helped quite a bit. These numbers looked a lot worse earlier today. We'll start at the bottom, right? 9 out of the 11 sectors were down today. So even though the benchmarks kind of got, regained a lot of their losses earlier today, this is a pretty rough day for a lot of sectors. And what happened is tech was up 1.25%. That one sector is about 40% of the benchmark. So all these other sectors, some of these were down pretty big. So this is a big risk off day for the materials sector, down 2.6%. Big down day for financials, down 1.9%. Big down day for consumer discretionary, down 1.8%. So it's a bit misleading when you look at the benchmarks. You think, oh, it wasn't that bad of a day. It was a pretty bad day for a lot of sectors. And as we'll see here, the breadth data was relatively weak today. It's actually one of the weaker breadth days we've seen in quite some time. So at the sector level, 9 out of the 11 sectors down. Energy up 1.8%. Technology up 1.25%. And again, I mean, that one sector really drives benchmarks more than anything. So that one sector up a decent amount far outweighs all these individual sectors that are down. That doesn't help you if you own a bunch of financials and material stocks and you got crushed today. Energy, of course, moving higher. I mentioned my own position betting on long energy, and I bet, put that trade on when I saw energy stocks and crude oil prices coming down to the point where it felt like the market was pricing in a Goldilocks situation where just things were better in the Middle East. And I just find that remarkably hard to believe. I am hopeful, as always, that things resolve in a peaceful way and that this is not something we have to think about or talk about for quite some time. But it certainly seemed like the market was under appreciating the likelihood of some sort of mean reversion kind of thing. And I think this week we're sort of seeing that play out pretty good. So that trade, which had been underwater, a lot less underwater with yesterday and today with a nice spike in energy stocks. Here's what I was talking about. The breadth is not bad. When's the last time I've shown this breadth indicator widget and they've all been bearish? Like, I can't remember the last episode where that's been the case, because the breadth has been generally positive, right? I mean, what we've been observing here over the last, month or so has been breadth generally positive. Advanced decline lines breaking out, looking even better than the S&P and the Nasdaq, to be honest with you. Technology struggling, certainly some areas more than others, but that weakness in tech really, with strong breadth but weak technology, the benchmarks are still going to be flat to down. Here we're actually seeing the opposite. We're seeing tech up, which makes the benchmarks look okay, but the breadth shows you how how rough of a day it was. 28% of the New York Composite Index names were up, only 28%, 70% were down. On the S&P 500, even worse, about a 3-to-1 ratio, almost a 4-to-1 ratio, 78% decliners there. And that was pretty consistent across cap tiers, right? All of this breadth is fairly negative. So it's only one day, but I think that is certainly a theme to be watching for, because I would argue that the strong breadth has been a defining characteristic of this market, certainly coming out of Q2 and going into Q3. Now, all of a sudden, if that shifts, that could be a very different set of conditions, certainly for the stock pickers among us. Looking at the cap tiers and the different style boxes here, note that large over small was a key theme today. So, large cap ETFs generally outperforming their small cap benchmarks. It was also growth over value in some areas more than other. In the small cap space, pretty much everything was down, but in the large cap space, large cap growth, the only one of the 9 that was actually positive compared to large cap value that was down. So large cap growth, particularly technology, sort of that FANG trade coming back. And when you look at Dave's Dirty Dozen, sort of these leading growth names and related ETFs, look at these 2 names at the top of the list. 2 stocks that have been underperforming the technology sector over the last month. 2 stocks that have been pretty ugly charts relative to the strength in names like Micron and SanDisk. Charts like Broadcom and Nvidia have been disasters, right? They've both been in a pullback phase, both bouncing higher today. And so we're kind of getting a bit of a mean reversion here from some of these charts that have been beaten down. Now, I would say the chart of Broadcom still has a lot to prove. I would argue that the chart of Nvidia still has a lot to prove. I mean, nice one-day move with Broadcom up 5% or so, Nvidia up almost 4%. But not enough that I think those charts look great yet. They're both sort of testing support and today appear to be bouncing off of there. Let's still make sure that those support levels hold. On the downside, Tesla continuing to not impress in the month of July, down 2.2%. Meta, which had a pretty decent bounce yesterday, down 2%. Microsoft and Alphabet both down over 2% as well. All right, let's get to the heat map. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. Hey, thank you guys so much, those of you that are tuning in live. Awesome to have you here. As always, please take advantage of being here live. Keep the show interactive, ask questions, and make comments all along the way. We'll try to take a question or two during the course of the episode. And if we miss your question or if we don't have time for it, we'll put it in the mailbag. We're planning an all mailbag episode on Friday. Those episodes are always a lot of fun to dig into some more thoughtful questions that we want to take some time to give thoughtful answers. But thank you guys so much for asking questions all along the way. It makes it fun to do the show and hopefully get your questions answered. All right, here's what the heat map looked like. And again, there are 2 sectors that pretty clearly stand out to me. I don't know about you, but I'm seeing technology in the upper left corner, kind of right about 2/3 of the way across, right in the middle. I'm seeing the energy sector. Besides those 2, not a great day in terms of breadth, right? I mean, if you cover up technology, if you cover up energy, the other 9 sectors obviously look varying degrees of bad to quite bad, right? And so I think this was very much a limited number of names doing well. It was just the right names and certainly the right sector doing well to make the benchmarks do as well as they did. So having said that, let's start with the good news. What was up? Well, obviously the energy sector up pretty good. And I would say, listen, if you've been ignoring energy because you've been like, all right, things in the Middle East are kind of cooling off, why would I look at energy stocks? Let's note that Valero made a new all-time high today, but that's actually the latest new all-time high because it's been making a new all-time high pretty much for the last week or 2. So even though crude oil prices have come down, not all energy stocks are looking too bad right about now. Valero has been in a pretty steady, consistent uptrend. MPC, Marathon Petroleum, made a new all-time high earlier this week, continued to push to new all-time highs today. So some of those stocks have been pulling back, right? Like Chevron, way below previous all-time highs, above $200 a share. It's still around 175. So a lot of space between where we're at now and where we were. But compare that to some of these others like PSX kind of pushing new all-time highs. So certain groups within energy looking a lot better from a technical perspective. Not all of them. While their day-to-day movements are certainly affected by crude oil in significant ways in a lot of cases. The general trend, I would say the technical setups, right? The different trend and momentum pictures are actually very, very different. And while CVX, I would say still at the lower end of its range for the last 3 months, something like PSX at the upper end of its range. And so recognizing strong versus weak within that energy sector, I think, is pretty important. Having said that, a lot of those names that have been doing pretty well, all sort of rotating higher today, particularly Valero, MPC stands out. And then the others, PSX is another one, others which have been more beaten down, like COP, like CVS, like OXY Occidental, kind of bouncing off of more of a lower level. So different groups doing different things right about now. Other sector that obviously did quite well in technology. I think the biggest change from what we've been observing here recently, because again, I think one of the great benefits of doing a daily market recap, a part of your daily process, is just think about what was new, what was different, right? What sort of maybe happened today that would cause you to rethink some of the investment theses that you've been, communicating with your positioning in your portfolio. I would say one of the things that's been very clear is in the technology sector, it's been strong semiconductors, it's been weak software, and the big semiconductor, right? The mega cap semiconductors, names like NVIDIA and Broadcom, have been struggling. Today, you're getting the opposite in a lot of cases. NVIDIA and Broadcom actually doing quite well. Other names like SanDisk, which have been, doing well, but pulling back this week, also having a decent bounce. Western Digital and Seagate, good to see both of those popping up today. Are the trends good? Like, no, I mean, they're still on the last couple of weeks, still trending lower, but a nice counter trend move today. So I would say the biggest shift today that I'm seeing looking at the technology sector, software generally still weak, semiconductors generally pretty good. It's the fact that NVIDIA and Broadcom sort of rotating higher, and that's encouraging to see because both of those are actively testing some pretty key support levels, which I'll show you in a minute. All right. So unfortunately, that's about the extent of the good news. I mean, other than that, it's really sporadic. You can see some random names in random sectors that had a decent day. And I would say particularly the big box retailers jumped out. Walmart, Costco, especially Target. And I would say out of those three, Target by far the most constructive technical configuration. And to be honest, I had an interview last week with Carter Worth of Worth Charting. He's a smart guy and a fantastic and accomplished technical analyst. Used to see Carter all the time in my Fidelity days. I don't see him as often these days. It was really cool to chat with him. But this picture of Walmart versus Costco versus Target is one of those things we would do all the time in his meetings, right? And I think this is an important way to think about it, right? Three stocks essentially in the same group. Here's Walmart testing the 200-day, now breaking below it. Here's Costco, testing the 200-day, breaking below it. Here's Target, way above its 200-day, still holding the 50-day moving average, just kind of in a nice, consistent uptrend. So which of those three has the best technical configuration? I think very straightforward, right? And so when you think about a sector like consumer staples, when you think about a group like the big box retailers, looking at the charts and just recognizing, all right, Target looks different for whatever fundamental reason, whatever you think it might be. The fact remains that Target is in a much better setup than those other names, right? And I think if you look at the momentum, look at how the RSI has held 40 on Target, and you can't say the same for those other two charts. So I think something like in consumer staples, great opportunity to think about the group and recognize a lot of times the groups look the same, but sometimes they do not. And this is one of those times where they do not. In terms of other things to be a bit concerned about, I would say just looking at the data today, materials having an absolutely disastrous day. It was kind of across the board with a lot of different groups. The materials sector was, doing okay for a couple of weeks, but now you're seeing all of those names that were making new 3-month highs. A lot of these I remember for the 3-month highs list because I run that a lot of times midweek. A lot of those rotating lower after appearing on that list earlier this week. Also, weakness in the financial sector. We've been identifying a lot of really interesting charts in the financial sector, and through last week, some really interesting setups. A lot of those names pulling back here this week. Is it bad enough to really rethink, charts like Visa or MasterCard? Like, no, these are 1 or 2 day moves after a new swing high, but certainly something I'm going to be watching to see if there's more sort of profit taking and or rotation away from some of those charts. So again, this was two sectors that did quite well today. If you remove those two sectors, the rest of the market did not look very good equity-wise. the strength in technology continuing to save this market in terms of the strength of the benchmarks. All right, we're going to continue on in a moment. I do want to let you know, my friends at Seeking Alpha have a virtual event coming up next week on July 14th. Steve Kress, who runs their quant team, will be hosting a top stocks for the second half of 2026 virtual event. It is only for premium and pro members. Good news is if you go to marketmisbehavior.com/seeking alpha, you can get a discount on a new membership. You can scan the QR code that you see on your screen or go to marketmisbehavior.com/seeking alpha. Using that link will get you a little better deal and also give you access to that virtual event. They also usually do a really good article summarizing some of those takeaways. You'll have access to that as well. I'm excited to have Steve Kress back on the Market Misbehavior podcast. I think that's coming up next week. Is that true? No, 2 weeks out, Tuesday, July 21st. So hopefully I'll be able to ask him some of the key takeaways from that event. But you want all the good stuff, you should sign up for a membership there. And thanks again, my friends at Seeking Alpha, supporting Market Misbehavior. All right, let's go through some charts. We'll take some questions. We'll call it a day, shall we? Here's what's happening on the daily chart of the S&P 500. The RSI is still neutral, was still below 60, still above 40. So I think that's still a sideways event. Yesterday, we talked about the failed breakout in the S&P. We had highlighted this as a coil pattern, very symmetrical triangle pattern. You can see we closed above it on Monday session. Tuesday, yesterday, we actually closed right at that upper trend line. Today, we went below it. Kind of an interesting thing happening today on the S&P. You probably call that a hammer candle, I would say, is how I would generally call that. Pretty good finish. And so I think the strength that you saw in the afternoon really turned this into a much more constructive day. And certainly when you look at the candle chart, certainly a much more constructive setup. Midday, it looked like the 50-day moving average. I'm wondering if that's going to hold. And it certainly did. Buyers come in and push the price back up toward the highs of the day. Maybe another retest of that upper trend line could be in store for us through the remainder of this week. For now, this is still an active pattern. I think the market's still in a consolidation phase until and unless we get a follow-through, a breakout, and then a follow-through above that upper boundary. I'm inclined to see this as negative. We also covered on yesterday's show the breakdown in the QQQ. Similar coil pattern, but it's actually breaking below. Did we get a follow-through day today? We did not. We actually closed back up right at that trend line, kind of the opposite of what happened on Monday and Tuesday for the S&P with a breakout and then a retest of the breakout level. Here we have a breakdown and then a retest of the breakdown level from below. So for now, Nasdaq not getting a follow-through day, momentum still quite neutral there. I think we're still in a neutral posturing in terms of our assessment of the chart. You know, the advanced decline lines are all pretty constructive here. I can't help but notice that the New York Stock Exchange advanced decline line, which is the most important one that I follow, just starting to tick lower a little bit. I mean, is this a bad trend? Like, no, it's still a clear uptrend of higher highs and higher lows. We're still above an upward sloping 50-day moving average, but that rotation lower this week certainly drawing my attention. So I immediately looked at the McClellan Oscillator. Now, why do I think of this little move in the advanced decline line and immediately think of the McClellan Oscillator? Because the McClellan Oscillator is derived from the NYSE advanced decline line. And it essentially is measuring the slope of that or the change in that advanced decline line by looking at some moving averages of the AD line. And so the McClellan Oscillator remains above zero, but you can see how it started to turn down a little bit. When it goes below zero, that can often be the sign that whatever uptrend we were experiencing, maybe that's in a position of weakness. Weaker breadth here would, potentially put pressure, certainly on the equal weighted S&P, maybe on the cap weighted S&P. That might be more about technology than anything else. But I would say as long as the McClellan Oscillator holds zero, the breadth is still okay. But the breadth was pretty negative today. So I think this chart might actually come into play. We haven't talked about this one a lot because the breadth has generally been pretty positive, but rotating lower just often can mean we're in a bit of a pullback phase. So we'll see if the breadth can remain positive. For now, it is doing so. One of the charts that really stood out to me today as I was prepping for the show is this one. This is looking at the new 52-week highs and new 52-week lows. New highs are in green, new lows are in red. Here we're looking at that comparison for the New York Stock Exchange and the bottom panel for the S&P 500. You know how many S&P names made a new 52-week high today? 6 or 8, whatever that number is. It's a really small single-digit number. So that means Not a lot. That is a very small number of names. That's less than, what? It's 1.5%, 1.5% of the S&P 500 made a new 52-week high. In the last couple sessions, it's been more about 10% of the S&P making a new 52-week high over the last couple weeks. So this was a noticeable shift where there were just very few names, breaking out today. Now, is one day a trend? It is not. It's one day. But one of the, I think, defining features of this market coming out of Q2 going into Q3 has been strong breadth. That's been just something we've been taking for granted, that breadth conditions have been so strong. And on a day like today, it's I think striking how the lack of breadth support certainly was a story on today's session. So does that turn into something more significant? Too early to say, but I think that is a noticeable shift that I picked up that I think we want to follow. Another shift to pay attention to is the Chaikin money flow. That's the indicator here at the bottom. This is looking at the S&P 500, and it basically is a 1 month look back. So it's kind of looking back at this last month and determining based on the daily volume readings and where we close in the daily range, what's the general volume? Are we seeing more accumulation or more distribution? We've been seeing distribution over the last couple of weeks for that 1 month look back period, right? But as you can see, the Chaikin money flow is starting to turn higher a little bit. Does the Chaikin money flow get back above zero, which would mean we're finally back in a period of accumulation? That would actually be a pretty encouraging sign. And when you think about what could propel the S&P and the Nasdaq out of this range to the upside, better volume, signs of accumulation, signs that institutions are adding some positions certainly wouldn't hurt. And we're not quite seeing that yet, but it's getting close. Now, here's what happened to the VIX. The VIX moved up pretty aggressively. It got all the way up to 19, but then by the close back below 17. So the VIX still very much in a low volatility environment. That spike that we saw in the VIX really didn't hold. We closed back toward the lows of the day. So I'd say at this point, the VIX is still telling you things are just fine. We want to see on a closing basis a push above 20. That would be a red flag. I don't think that red flag is being waved just yet. Here's the chart of crude oil. We talked yesterday about that spike on the headlines implying a renewed escalation of a conflict between the U.S. and Iran and others. We can see today further upside in crude oil prices. Crude oil getting back above the 200-day, which I think could be important, right? That breakdown of the 200-day in mid-June was a really important sign that there was big-time distribution and no particular end in immediate sight. We're now seeing a meaningful bounce off of 67, and now we're up to around 75. Getting above $80 a barrel, I think for me would be the confirmation that we're now in a new uptrend phase for crude oil prices, but we have regained the 200-day. The momentum is still not very strong, but that chart, I think, obviously very, very important, certainly for the energy sector, but implications there for consumer sentiment and much more. Offense over defense over the last couple of weeks, really favoring defense. I would say these charts are generally still neutral, but I am noting over the last couple of weeks a rotation away from consumer discretionary and into consumer staples. So things you want moving to things you need, and that's usually the sign of a market under pressure. So as you can see, I mean, just as we're going through these charts, there's like some good stuff, and then there's some bad stuff. It really is very mixed at this particular moment. I would say when I look at all the measures of trend, the S&P and the Nasdaq are consolidating. When I look at measures of breadth, they're generally positive. When I look at signs of leadership, not so much, because I'm seeing an improvement in defensive sectors. So it really is a mixed bag of evidence, I would say, thinking of the macro technical inputs. All right, let's finish off looking at some stock charts that I have hand selected to review with you, starting with NVIDIA. Nice bounce off of the 200-day moving average today. We talked recently about that test of the 200-day for both NVIDIA and Broadcom. Here in the chart of NVIDIA, that bounce off of 190, 192, I think is a pretty important one. We have an alert set for 190 because a breakdown below there, I think, would be pretty negative for NVIDIA and certainly have some negative implications, maybe more broadly for semiconductors. But for now, decent bounce, just further validating that importance of that support level around 190 to 192. Here's the SMH getting back above the 50-day moving average after closing below it yesterday for the first time since early April. SpaceX not necessarily getting the love today on a closing basis. We actually closed below the opening price from early June. That was at 150. We closed below there at 148. That's the first, close really below that level, although yesterday was technically just slightly a hair below it. Today we're seeing further downside. So the SpaceX IPO at this point seems like a nuh-uh. Let's wait a little bit and look for some sign of accumulation. Limited history for now, but failing there for now. We highlighted Berkshire Hathaway yesterday on the show. Actually, I think we might have highlighted it on Monday. I forget, but yesterday we talked about this bearish engulfing pattern. Bearish outside day is really a better way to describe it. Bearish outside day. Day 2, wider range, lower close, usually means the next 1 to 3 bars are negative. And unfortunately, we played out exactly what that pattern would imply. So what this means is we had yet another test of this kind of 505, 510 level. You can see that every previous rally going back to last summer has stalled out at that point. We stalled out yet again at that point. So we're further reinforcing the importance of that resistance, which for me means you need to see Berkshire get above 510 to be at all interested in that chart, at least for now. Unless we get so low that all of a sudden it looks like we're at the lower end of this range and you're betting on mean reversion. But for now, in terms of the trend appears stalled out. Hasn't broken below the 21-day EMA, still holding it. But I think that candle pattern, as it tests resistance, is a problem. This is not a perfect example of this, but I'd probably label this a bearish Harami pattern, which is where you have a big up day and a big down day. Day 2 is narrower than day 1. So it's not a bullish engulfing pattern. That would be a higher open and a lower close. Here we have what we probably call a bearish Harami pattern. It's also negative. So next 1 to 3 bars in waste management, ticker WM, is important too. The reason I want to highlight this, we got to the overbought region yesterday. And one of the things that I have found is using something like RSI along with something like candle patterns can be really helpful, right? So when we get to a level momentum-wise that it feels like we might be, overbought, sort of overextended, a bearish candle pattern a lot of times can confirm, yep, that was definitely overbought. We'll probably get a bit of a pullback. So chart of WM suggesting next 1 to 3 bars lower after that bearish pattern. So what was working today? Obviously tech. We've been covering tech plenty. Let's talk about some of the strength that we're seeing in the energy sector. It's a mixed bag of names like Halliburton that have not been doing particularly well. Had a pretty rough June, but now we're getting a bounce off of the 200-day. Look at that bounce off of the 200-day and rotation higher this week, which is pretty encouraging. That's after being oversold on a test of the 200-day. But then you have other names like Valero, like MPC. They're actually making new all-time highs today, right? VLO is actually up 6+%, but breaking out of this consolidation. RSI pushing above 60. So there are good charts out there. They're just in kind of different places. And I like the relative performance, by the way, relative strength making a new 3-month high. That's something that I noticed as well. All right, there we go. Let's take a question or two. And let's see what we can answer. I love that question. I'm going to answer that second. So what we're going to answer first. No, really good comment here. Josh, thanks so much for watching live on YouTube. You mentioned Alibaba, ticker BA. Actually a nice gap higher today. And that was quite a shift. And with things like this, right, with charts that are going down, I usually ignore them until we break above the 21-day EMA, right? Unless you get that basic thing, it's like there's just not enough happening. Now I feel like you may have to reevaluate that for sure. Love to see if there's follow through tomorrow. And if it holds that initial level of, that initial kind of stop, the 21-day EMA, maybe this could be the beginning of something more significant, also breaking above $100 a share, which is often kind of an encouraging sign as well. Will that be enough to really follow through? Open question. We'll see. Pepsi's another one, obviously in the consumer staples sector. This is one that tested the 200-day, and look at the action has not been great, right? So we had a swing high at the 200-day mid-June. We actually got right back to that level yesterday. Look at the open, the close above the 200-day, but then it repelled that breakout, right? And we closed back below. So not surprising, I would say, given yesterday's action, to see negative follow through. So not a great setup going into earnings. The chart of Pepsi for me is like above the 200-day. That's a pretty interesting chart. Below the 200-day, there's probably better things that I can find. So I'm not probably going to waste my time on it. But I think the 200-day would be pretty key to watch there. Kind of interesting bullish divergence, I think you would say, in the month of June. Something to watch. Last question, Chuck, thanks for watching. As always, my friend, you said, How does taking some days away from the market help you? I will tell you this. I am a big fan of one of the central tenets of market misbehavior, and honestly, how I have set up my own professional life in 2026. Because I was just talking to my wife about this yesterday. We were sitting outside, just, on the patio, and just talking about life a little bit, as we often do, and we're talking about this sort of theme. I am a big fan of taking breaks, and I have found so many people get burnt out from staring at charts and staring at the markets. And I don't care if you're trying to have a good P&L. I don't care if you're trying to grow a business, which is what I'm trying to do. Nothing is worth your health and your happiness and your mental capacity, right? Working so hard that you can't enjoy it is just not worth it. And some may disagree with me, and that's fine. But I firmly believe that that's true. I have learned the way that I manage, the mental challenges of being in an industry that is built around gaining and losing at times large, incomprehensible sums of money at times for shareholders and for yourself. I would say, the way you do that is, for me, having a morning routine that is focused on mindfulness. So after I shower and stuff, I have an espresso, I write in a journal, I light some incense, I put on some kind of Zen yoga type of music, and I just kind of chill out and just have some quiet time. That is my favorite part of the day by far. It's so important to me. And I've been doing that for so many years. I can't remember a time when I haven't been doing that. And so that's pretty cool. The other thing is getting outside, and we're fortunate living where we do that we have a lot of really good trails nearby here in the Seattle area. So after the close, usually by about 3 p.m. Pacific, I try to be out somewhere having a workout or on a trail somewhere, just having a nature bath and just kind of reflect on things. Going on longer hikes and longer bike rides when you can do that is super helpful. That's when I'm happiest. And to be honest with you, charts, I would argue, if all you do is stare at charts, and this may be controversial to some of my peers in the CMT Association, I would say that if all you do is stare at charts all day, you're not going to do as well than if you intentionally and thoughtfully and consistently look at charts, but also intentionally and consistently and thoughtfully don't look at charts and get out and look at something else and look at trees and flowers and listen to music and be with your family and do other things. Otherwise, the charts, for me, coming back to the charts after I've had that break, everything makes more sense. I see relationships and patterns that I wouldn't otherwise. When I'm on a hike, I randomly get my phone out and say, you know what? I'm now realizing that thing I was worried about before. This is what I need to do. And that has become so clear to me that I can't imagine not trying to do those things. So those are things that I try to do. Hiking is not for everyone. Riding your bike's not for everything, but find that thing that it is for you, whether it's painting or music or deep breathing or reading or going out with friends or whatever, and make sure that you make time for that. Otherwise, what are we doing this for? Thank you for that philosophical question. I hope that inspires you to go take a break somewhere this evening. In the meantime, I will say thank you guys so much. Those of you tuning in live, asking great questions, keeping it interesting. If you're watching the show on our YouTube channel, please drop a question in our comments section. We love to feature your question on Friday's all mailbag episode. That's it. Have an awesome night. And remember, it's always a good time to own good charts. Take care, folks.